So I'm all in one piece.
You're perfect. Okay, I will ask everyone to take their seat. We're about to start. Thank you. Okay, why don't we start? So I want to welcome everyone to the 23rd Mundell-Fleming lecture. My name is Pierre-Olivier Gourinchas. I'm the chief economist here at the fund. And it's my great pleasure to welcome and introduce Linda Goldberg as our speaker. Now, Linda is the financial research advisor at the Federal Reserve Bank of New York. She also co-chairs the International Banking Research Network. She's a BIS technical advisor, a CPR distinguished fellow, and an NBR research associate. Linda's work has covered a wide range of topics in the domain of international macroeconomics and finance. Her work on global banks has elevated our understanding of how these banks manage liquidity shocks and how they contribute to the propagation of international shocks, an important question that emerged especially following the 2007-2009 crisis. She has also worked extensively on topics related to capital flows, global liquidity, and prudential policy responses and spillovers. More recently, her work has focused on the role of the US dollar as a dominant currency and the effectiveness of the Fed's central bank swap lines in reducing strains in global US dollar funding markets during extreme stress events. She's published extensively on these topics in top journals and is one of the most influential economists in the field of international macro and finance. Now, in today's Mundell-Fleming lecture, she will focus on global liquidity, a concept central to international macroeconomics and financial stability and close to Linda's line of work. While past lectures have emphasized the role of monetary policy and its spillover on foreign countries, we've seen some of that work today, in driving global liquidity, the focus of today's lecture will be on risk sensitivities as drivers of global liquidity. The lecture will emphasize the role of individual market participants, in particular their health, risk-absorbing capacity, and constraints in shaping the responsiveness of global liquidity to shocks. This is a topic of high relevance for both academics and policymakers as we think about the design, scope, and efficacy of policy toolkits available to countries and frameworks for when and how different tools are utilized. There's a lot of work going on in macro finance these days on the granularity of financial markets and how it shapes demand for different financial instruments. Now, before I give the floor to Linda, I would make two observations. The first one is that I believe, if my information is correct, that she is the third woman to give the Mundell-Fleming lecture, and we're very, very pleased to have her today. Not only for that, but also for that. Another little factoid that I will share with you is up until now, and we'll see if the record keeps, every single woman who has come and presented here didn't have to ask any question about how to use this little thing. They sort of knew how to do it. Every single man had to ask someone. Just leave you with that fact. Now, let me diverge briefly and dwell on the history of the conference. As some of you may remember, the very first IMF annual research conference took place in 2000 with Robert Mundell delivering the opening remarks with a keynote speech on the history of the Mundell-Fleming model. Now, one reason I mention this is that in that same conference, Maury gave the inaugural Mundell-Fleming lecture that was published the following year in the IMF staff papers at the time. Now, in that lecture, Maury outlined the challenges of the early international macroeconomic models and discussed the theoretical advances in new open economy macroeconomics, which synthesized Keynesian nominal rigidities, intertemporal approaches to open economy dynamics, and the effects of market structure on international trade. Now, you can see why this 23rd annual research conference is extra special. It celebrates the very first Mundell-Fleming lecture that Maury delivered in 2000, and tomorrow, Maury will also reflect on the contributions of Robert Mundell in a tribute that we will have in the afternoon, which will be broadcast, I understand it will also be broadcast live in St. Paul's Chapel in New York. Okay, with all this, without further ado, it's my great pleasure to give the floor to Linda Goldberg, who will deliver this year's Mundell-Fleming lecture. Linda, the floor is yours.
Glad to be here. So under any circumstances, it's an honor to present the Mundell-Fleming Lecture of the IMF Annual Research Conference. Thank you to Kristalina Georgieva and Gita Gopinath for this honor. Thank you, Pierre-Olivier Gourinchas, for your generous words of introduction. You are all united in your commitment to a well-functioning international monetary system, strong economies around the world, and addressing those vulnerabilities that limit the ability of countries to obtain their best outcomes. I'm going to speak today on my own behalf, and the views expressed are mine. They do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. I got that right? So it's a special privilege to be at this 23rd Jack Pollock conference, as during these 2 days, we honor Maury Obstfeld, an economist for whom we all have tremendous respect. Maury has made so many deeply insightful contributions to our understanding of international monetary history and international finance more broadly. Some foundational contributions are in modeling intertemporal considerations, for example, his work with Ken Rogoff on new open economy models, which served as the starting point, actually, for Pierre-Olivier's Mundell-Fleming lecture last year. Pierre-Olivier showed how theory is increasingly able to incorporate economic and financial granularity, networks, frictions, heterogeneity. I will discuss this granularity, but from an empirical perspective. I am personally inspired by Maury's scholarship and intellectual integrity, and his deep thinking about big picture questions of the entire international monetary system. Likewise, by Maury's capacity to position his observations into the broader contributions of diverse thought leaders, taking sweeping views of history of thought on these topics. And in developing my own comments for this lecture today, I try to follow Maury's lead a bit. So I'm going to tie some of my key points to some history of thought that was showcased here at the IMF in past Mundell-Fleming lectures. The stamps of such rich perspectives are reflected in the broader work of the IMF Research Department and of the Monetary and Capital Markets Department. And importantly, as a community, we think about the design, the scope, and the efficacy of policy toolkits available to countries, and for frameworks for when and how different tools are utilized. And this brings us to the extensive work by the IMF on the integrated policy framework as a really important step forward. Countries face difficult trade-offs in policy. Research and analytics inform the prospects and the challenges around specific domestic tools, and those include macroprudential measures, foreign exchange intervention, and capital flow management measures. So my remarks today will also discuss these trade-offs and toolkits, working through insights around global liquidity. Okay, so what is global liquidity? So today, my remarks focus on this topic. In 2011, the Bank for International Settlements defined two types of global liquidity. Official liquidity is that component created by central banks. Private liquidity refers to the funding conditions of the broader international economy. It reflects the behavior of the financial sector in providing cross-border and/or foreign currency funding. So it's this private liquidity in particular that's my focus. I'm going to, in some of the conversation today, proxy it by the volumes of financial flows that are largely intermediated through global banks and non-bank financial institutions. And that could be reallocated at relatively high frequencies in the data. It could even be, within a day, it could be, or even within a month or within a quarter. Global liquidity is central to international macroeconomics, especially around international spillovers, monetary policy, capital flows, and credit provision. So within this space, my perspective is one that is shared by many previous Mundell-Fleming lecture presenters, and that is that exchange rates are determined in response to international capital flow pressures, and financial factors are the dominant driver. So I'll take the position that global liquidity is central to financial stability considerations that come from this. Now, two drivers of this private global liquidity are monetary policy changes, including those from the US, and risk conditions. In recent years, both have received attention in previous Mundell-Fleming lectures. Ellen Ray's influential works, including at the 2013 Jackson Hole meeting and the 2014 Mundell-Fleming lecture, raised important challenges about country toolkits. That US monetary policy receives attention in discussions of international spillovers and the global financial cycle is not surprising, given the centrality of the US dollar in the international financial system. Indeed, there are channels through which the monetary policy and the risk drivers overlap, including through the risk-taking channel of monetary policy. Ben Bernanke, in his 2015 lecture, called for more work on understanding cross-border financial linkages that reflect destabilizing spillovers as opposed to more benign factors. Later, the whole of the 2017 annual research conference highlighted different aspects of such spillovers. Gourinchas, in his 2018 lecture, discussed consequences of such spillovers for foreign countries based on his work with Douglas Diamond and Yunji Hu. And of course, all of this work has been incredibly impactful. My lecture has a particular emphasis on risk conditions as a driver of global liquidity. A key theme today of my lecture is that volatility of global liquidity is associated with the vulnerabilities of and constraints on the institutions participating in international financial markets. I will make a few key points from the vantage point of data at different levels of disaggregation by country, by types of flows, and across individual banks. And I will conclude today by talking about toolkits, building on the dedicated focus here and in the research community of the last decade. So before I spell out my main points, let's get on the same page with some other concept definitions. So this is now on prudential policies. Prudential policies include so-called micro-prudential work done within countries to make individual financial institutions more robust. We generally discuss prudential policies with respect to banking organizations, but this limitation is not required. The supervision and regulation of banking organizations includes a focus on how risk is managed, on the buffers that institutions have against types of risk, and on the approaches for recovery and resolution if the banking organizations get into trouble. Macroprudential work is about managing the cycle through tools through tools that can target specific sectors or financial activities. The so-called macroprudential focus certainly appeared on some radars early in the 2000s. Here at the IMF, in 2001, the conversation in front of the executive board was around furthering the compilation, use, and analysis of macroprudential indicators of the health and stability of financial systems in light of the experience that had been gained to date. This early focus on macroprudential indicators, however, was more closely aligned with early warning indicators than with a toolkit to directly influence the structure of financial activity. In the aftermath of the global financial crisis, efforts shifted towards developing toolkits to manage financial conditions associated with excessive booms and avoid damaging busts in credit availability. So macroprudential policies, as well as capital flow management tools, have now received more attention. So in my lecture today, I would like you to come away with a few main points that are relevant for both policy and for research. First, prudential policies dampen the amplitude of global financial cycles. Here, my message has a focus on the home country of the financial institutions. So the global regulatory community focused on large and internationally active banks after the global financial crisis. Strong microprudential policies and supervision have enhanced risk absorption and improved risk management. I will argue that banks with higher capitalization and better liquidity are associated with a lower amplitude response of cross-border lending to deteriorating risk conditions. Also, if large banks fail, improved recovery and resolution frameworks should shorten periods of disruption and unintended consequences from those failures. I will argue that more robust institutions and international financial flows relax some of the tight trade-offs articulated in international monetary and the international financial stability trilemmas. Second point, appropriately targeted policy requires a layered approach using granular data. Analytics using granular data on financial flows informs the constraints, the institutional features, and the amplification channels that are relevant for designing effective policy. In the case of global liquidity, granularity also means considering the players, those agents that are in need of financing, and the composition of creditors and investors. This type of granular perspective has motivated some of the important work presented by Hyun-Song Shin, as discussed in his 2011 Mundell-Fleming lecture. Hyun's contributions with Tobias Adrian take aim at understanding frictions and value at risk constraints in global banks. Hyun's work with Valentina Bruno highlights the financial channel of exchange rates working through banks. Both of these approaches are embedded in active agendas of researchers around introducing financial frictions into models. The Bank for International Settlements and other institutions are active in collecting some of this granular data from central banks. Institutions are investing in even more granular collections and in associated repositories for this data. So insights from analyses of granular data increasingly contribute to our understanding of mechanisms and frictions at work in shaping the dynamics of capital flows across borders. This type of granularity even shapes how we should talk about groups of countries and their respective policy challenges, and we learn where we have blind spots. We often talk about spillovers from home or source countries active in the international financial system. This granular data approach also focuses our attention on supervision and regulation in the home countries. The third point that I'll make is that risk migration occurs within global liquidity flows including in response to home country enhanced bank regulation and supervision. The increasing role of non-banks could threaten some of the gains achieved in weakening the response of global liquidity to changes in risk conditions. Some of the global liquidity flows, including the riskier projects and riskier borrowers, have migrated away from funding provision through banks towards more market-based financing. Non-bank financial institutions now play important or even dominant roles in some global liquidity flows. Non-bank financial institutions consist of a broad spectrum of agents distinguished by the riskiness of their projects, by their business models, their collateral holdings, leverage, and their access to sources of funding. The shift in composition can potentially undo some of the recent progress made, which I'll show, on dampening shock amplification after global regulatory communities focused on those large and internationally active banks. The fourth point is on the toolkit. Policy trade-offs in destination countries for global liquidity are improved when participating institutions have better risk management and risk absorption capabilities. The approach for banks has been developed. The approach for non-banks, less so. These points underscore the importance in an international context of progressing on the largely domestic country efforts to address the vulnerabilities associated with some classes of non-bank financial institutions. Weaknesses and systemic risks propagate across borders, and domestic policies have externalities. Also, developing effective liquidity facilities for official lender of last resort function associated with the official provision of global liquidity will play a role. I'll talk about that as well. I'll conclude with some open questions today for all of you in the policy communities and in the research community. And that is, what is the end game for risk migration? What is the right mix of debt and equity flows? And how is this ideal mix ultimately achieved? So equity markets can adjust quickly to shocks through asset prices. Equity owners absorb losses and volatility. Institutions and tax codes, however, can favor debt financing. So what is the right balance of debt and equity? How does this interact with global liquidity? And what do we want to work towards? Okay, so let's dive in to the content. So now into global liquidity. I'm going to start by taking us back to trilemmas. And again, throughout, I'm going to try to weave my remarks into the history of thought here at the IMF, but especially from Maury. So arguments about global liquidity tie closely to overall capital flows and relate to the classical monetary trilemmas faced by countries. The well-known monetary trilemma posits the incompatibility of three economic features: monetary policy autonomy, maintaining fixed exchange rates, and having free and open international capital flows. Maury Obstfeld has provided empirical evidence that some monetary policy autonomy exists, including for emerging markets, and especially for countries with flexible exchange rates. Countries with flexible exchange rates have better economic outcomes relative to countries under fixed exchange rate alternatives, even if complete achievement of domestic goals is not accomplished. Additional challenges for policy autonomy are highlighted around the financial trilemma, in which Dirk Schoenmaker builds on the more general principles of extensive domestic objective incompatibilities in a globalized world that had been argued by Danny Roderick in 2000. This financial trilemma brings into focus the conflicting nodes in the international financial stability realm that are sharpened by the substantial growth in cross-border financing over recent decades. In this case, the three mutually incompatible nodes are financial stability, non-intervention in cross-border financial flows, and national control over financial supervision and regulation. And actually at the IMF's 15th annual research conference that was on exchange rates and financial globalization, Maury discussed how financial stability policy is so much harder in open economies. He provided at that time some ingredients of a more efficient international system. And here are some of them. They included sound domestic macroprudential policies, in part addressing the inadequacy of monetary policy alone, domestic regulatory control over large foreign banking organizations. Since full coordination is politically impossible, he spoke to the need for rules of the road for capital controls, if they are at times needed to address nation-specific concerns. He spoke to enhanced facilities for international liquidity support in key currencies. And he spoke about more equity and less debt, and noted that this already was well underway for emerging market economies. So considerable progress has been made in developing and implementing the integrated policy framework here at the IMF. Regulators have also made some progress on the banking side, as I will discuss. And it also has been made on capital control frameworks and on enhanced facilities. At least as pertains to domestic macroprudential policies, one issue with effectiveness is that some parts of the toolkit are applied to specific types of institutions, for example, banks, instead of activities. More than a decade ago, the potential for risk migration was anticipated by researchers. Jonathan Ostry, Atish Ghosh, Marcos Cheman, and Mahvash Qureshi were early in the space of exploring the empirical consequences of macroprudential and capital control policies. They found evidence for indicators of financial fragility. However, they also noted the difficulty of using macroprudential policy effectively when activity can migrate to unregulated venues. Valentina Bruno and Hyun Shin observed that the shifting patterns of financial intermediation means that tools geared toward the regulated banking sector have diminished efficacy on the procyclicality of the financial system. That was in 2015. Maury, with Alan Taylor in 2017, emphasized the importance of focusing more on rapidly evolving financial markets as risky activity was being pushed outside the perimeters of regulation. And Alain, in 2017, called for a research agenda for the global financial cycle, including on the source, propagation, amplification mechanisms, and endogenous risk buildups, for models with heterogeneous intermediaries and moral hazard, because risk-taking was not being properly priced, among other things, and also for ex-ante regulatory policies, micro and macro prudential policies, capital flow management policies, and also on policies subsidizing debt. So all of Maury's ingredients here will come up in the rest of this lecture. I will set up issues pertaining to the trilemmas and the ingredients by considering the relationship between global liquidity and risk conditions. I will present evidence at different levels of data disaggregation and ultimately make arguments about the roles of prudential policy and then the challenges from risk migration. Okay, so we'll start with international capital flow pressures. International capital flow pressures manifest as an excess demand for foreign currency relative to domestic currency. Global liquidity is a big portion of these flows. Exchange rates are frequently used as indicators of these international capital flow pressures. However, Some countries, through central banks or finance ministries, at some times, meet excess demand for foreign currency by foreign exchange intervention instead of letting all of the international capital flow pressures materialize in the currency depreciation. Similarly, when there are appreciation pressures on currencies, some central banks accumulate official foreign exchange reserves instead of realizing the full currency appreciation. In these cases, the exchange rate is no longer a sufficient statistic for international capital flow pressures, either across countries or over time. The new Exchange Market Pressure Index from Sina Krogstrup and I includes the actual rate of currency depreciation or appreciation that occurs, along with contributions of both foreign exchange intervention conducted and monetary policy changes through interest rates. So these are added up. But FXI, foreign exchange intervention, is a quantity, for example, billions of euros or US dollars, while currency depreciation is a rate. So how can you add a quantity and a rate? What we do is derive the factor that converts how much currency depreciation was avoided by that foreign exchange intervention. The derivation starts with the standard balance of payments accounting, which captures the flows associated with net exports, interest payments on foreign debt and interest earnings, and changes in gross foreign asset and liability positions. In the balance of payments, foreign exchange intervention is the residual of all of the other currency flows across borders for a country at a point in time. As the exchange rate influences some of these flows, we work through how much of a change in the exchange rate, which ends up working mostly through financial channels, would have been needed to generate such an excess demand for foreign currency. This gives our conversion factor. It represents the quantity of currency depreciation avoided by every billions dollars or euros of foreign exchange intervention by country. It's country and time specific, and it depends on features like country-specific gross foreign assets and liabilities, the currency denomination of these positions, and the sensitivity of different types of investors to shocks. We compute monthly series for the EMP for a large group of countries, and we use this to demonstrate today, and in our research, the evolving risk sensitivity of international capital flow pressures. Our Global Risk Response Index is a rolling 5-year correlation between exchange market pressure and a measure of risk sentiment. And in my comments today, I'll be working with the VIX. This slide, this exhibit, shows in blue, so this is data from 2005 through 2022. And the upper part, this panel shows in blue the averages across advanced economies at each date in this risk response, Global Risk Response Index, along with a standard error band showing variation across countries at that date. So the blue is the band for advanced economies. It shows in red the comparable averages across emerging market economies. The exhibit demonstrates a broadly accepted characterization. Increases in the VIX elicit a much greater risk-off pressure, notice that it's negative, on emerging market currencies. Negative values are the tendencies of a currency to depreciate when risk sentiment deteriorates, and the VIX is higher. These depreciation tendencies are stronger across emerging markets compared to advanced economies. And if you look at this picture, you might conclude that across these two groups of countries, the difference in risk sensitivities are no longer pronounced. This inference is misleading. It also provides a first take at where looking at granular data is helpful. The past decade has focused our attention on safe haven properties of some currencies, with the dollar associated with convenience yields and the US considered a liquidity provider or global insurer. Many of you have contributed insights on this topic. Some other currencies, however, also exhibit the so-called safe haven currency characteristics, as these countries are net recipients of global liquidity flows or experience similar international capital flow pressures as the dollar as risk conditions deteriorate. This next exhibit separates these so-called safe haven currencies from the broader group of advanced economies. So the safe havens are, I don't know, what's that color, purple. And the EMs are red, and the other advanced economies are now in blue. Abstracting from the so-called safe haven currencies, other advanced economies and emerging markets exhibit similar risk sensitivities. Advanced economies are not appropriately combined into a single category when considering policy channels from risk-induced international capital flow pressures. The risk sensitivity for the currencies of other advanced economies and those of emerging market economies are quite similar after the global financial crisis. Meanwhile, risk sensitivities have trended downward for the so-called safe havens. Why? For answers, it's important to understand the composition of players in global liquidity flows. Increasingly granular data will now help us to understand the drivers of these reduced sensitivities and to gain new insights on whether the status of lower risk sensitivity is likely to persist. Here, it's helpful to have a schematic in mind as we consider the players. So as you look at this schematic, the boundaries of country A are indicated by the dashed orange lines. Within country A are banks on the left and all others in need of funding on the right. The global liquidity flows to borrowers within country A can be intermediated through banks there on the upper left, that's cross-border lending, and through non-bank financial institutions in the upper right. On the left, we see cross-border loans made by the internationally active banks to domestic banks. Internationally active banks also directly fund the non-bank borrowers in country A. This funding can take the form of syndicated loans, or sovereign loans, or syndicated lending to large non-financial corporations, exporting and importing firms, and leveraged non-bank financial firms. Some global banks also engage in cross-border lending to their branches and subsidiaries located in country A. Intra-bank lending within the organization is how global banks manage liquidity across parts of their organization around the world. The hosted banks then provide loans and services within the borders of country A. The right side of this graphic shows the role of global players in the non-bank financial intermediation space. Funding through non-bank financial institutions or NBFIs is sometimes described as market-based finance. This can be through purchasing international debt securities, IDS, that are issued by banks or non-banks within country A, and the purchasers of these securities tend to be pension funds, insurance funds, money market funds, and hedge funds. How large are these different types of flows? My recent research with Stefan Avgiev, Leonardo Gambacorda, and Stefano Schiaffi expands on earlier work we published in 2020 in the JIE. Our current analytics look at BIS data on cross-border loans and international debt securities aggregated at the country level, with series here that cover 44 lending countries and 64 borrowing countries, 2000 through 2021. These exhibits show the evolving composition of bank-based funding and market-based funding for borrowers in advanced economies, those are on the top panels, and emerging markets on the bottom panels. We separate the banks as borrowers on the left from the non-banks as borrowers on the right. Red blocks show outstanding cross-border loans. Blue blocks show outstanding international debt securities. While banks have experienced moderate shifts in funding sources, non-banks have tilted sharply towards market-based finance. So focus your attention on the left panels, which depict how bank borrowers are financed internationally. Both in advanced economies and in emerging markets, banks have had relatively steady positions in global funding in recent years. Cross-border loans, represented in red, are the largest form of international funding for banks. Focus your attention on the right panels, where the most dramatic shifts in the composition of global liquidity are for non-bank borrowers. This change is evident both within advanced and emerging market economies. Next, we could take that same data and by country, by date, deflated by GDP. Then we consider the median values of these series across countries and by date. After the global financial crisis, the median advanced economy has international debt securities issued by non-banks financed at about 25% of GDP, the scale, while the median emerging market economy has experienced sharp increases over the last decade from around 5% of GDP to 13% of GDP. Now let's go back to the big picture and back to Maury Obstfeld, as he so often places lessons in the context of international financial history. In 2005, Maury and Alan Taylor published their book on global capital markets. Many of you will recall their stylized visualization of history from the mid-1800s to 2000. The first era of financial globalization occurred prior to 1914, then collapsed during the interwar period. The world economy experienced the second era of financial globalization from 1980 through 2000, which was the end of their sample period. So next, I provide my own brief history of the period since 1980. For this purpose, I'm going to return to the stylized diagram introduced earlier and argue that the period from 1980 through the present will be divided into 3 episodes, also helping to motivate a bigger and more durable point about risk migration in global liquidity. So let's go back to this picture. Okay, episode 1, starting with 1980. So this is 1980s to the early 1990s. Global liquidity flows started out bank-based and to sovereign borrowers. This is reflected in the pattern of bold black arrows. Let's go to episode 2. Episode 2 is the mid-1990s through early 2000s. Often, following financial crises, countries liberalized their capital accounts and permitted more participation of foreign banks in their local economies. Global banking expands through branches and subsidiaries in foreign locations, and then direct lending also increases to other non-bank customers. Other banking services also were more broadly provided within the boundaries of here country A, and global banking during this period became more complex with many legal entities as part of these financial conglomerates. Plus, there was some nascent increase in the role of non-bank financial institutions. We move on then to the third period, the third episode, which is after the global financial crisis to the present. This last and current period is an expansion of rapid global liquidity flows directly to non-bank borrowers and an increasing role of NBFIs. Part of this arose as regulation generated risk migration away from banks, and technological changes also occurred. So next, with this kind of dynamics in mind, our analytics use the borrower type and funding type granularity by country over time to explore evolving risk. And also the work has monetary policy, but I'm going to focus on risk sensitivity over time, along with drivers of these changes. Sensitivity of these flows are explored relative to the VIX. However, robustness has been done in some parts of the work using other measures, for example, using the RORO measures of Chari, Dilt-Stedman, and Lundblad, and the risk sentiment measures from Bakart, Engstrom, and Zhu. Okay, so these next slides draw on my new research with Stefan Avgiev, Leonardo Gambacorta, and Stefano Schiaffi, and our earlier work in the JIE. The data used cover our BIS statistics. They cover international debt securities and cross-border loan lending by bank and by non-bank borrowers. The analytics consider characteristics of source country banking systems and composition of non-bank financial institution types in inflows from the perspective of the borrowing country. So the econometrics look at estimating sensitivity to the global factor components that we've all spoken about, changes in US federal funds rate or the shadow policy rate, risk sentiment, GDP growth. There are controls for local pull conditions. We estimate sensitivities pre-global financial crisis, patterns over time post-global financial crisis, separate out borrowers by these three groups: safe havens, other advanced economies, and emerging markets, and then test for drivers of the sensitivity, focusing on composition questions and characteristics of banking systems and the non-bank financial intermediaries. I illustrate the findings of some of those analytics applied to granular data at the country and funding type level here for emerging market borrowers. So let me spend a minute just talking through this complicated set of 6 graphics, but I think they're pretty interesting. So the upper row of these graphics refer to cross-border lending. In all of these graphics, these are estimated risk sensitivities of different types of flows to the VIX. The bottom row is on international debt securities issuance, top again on cross-border lending. The leftmost set of exhibits are the total of all of these global liquidity flows, so the sensitivity of the totals. And in the middle, you have the sensitivity from the perspective of bank borrowers. And at the far right, you have the sensitivity from the perspective of non-bank borrowers. As you look at these exhibits, so remember, we generally expect that when risk conditions deteriorate, there's going to be a decline in these types of global liquidity flows. So how big are those declines? The orange lines in each of these exhibits show us the pre-global financial crisis sensitivities. So those are the horizontal orange lines. The blue lines are the post-global financial crisis sensitivities that are computed by sequentially adding quarterly observations. And these blue lines are surrounded by a 90% confidence interval at each date. The sensitivities to risk of different types of flows vis-a-vis borrower types have changed dramatically. Across emerging markets and across other country groups which are not shown, all borrower types have reduced cross-border lending sensitivity to the VIX. This is illustrated across all of the panels of the top panels of these graphics, whether it's in the total amount of cross-border loans by country, from the perspective of banks as recipients of interbank funding, or on the right, from the perspective of non-bank borrowers. These risk sensitivity results through bank lending, the top row, stand in contrast to patterns in market-based funding for bank and non-bank borrowers. Risk sensitivity of international debt securities has not declined and exhibits considerable heterogeneity across borrowing countries. Remember, this type of funding has grown in importance, and it is also less transparent and more heterogeneous, as I will discuss shortly. There are important differences across so-called safe havens and other advanced economies not shown here. In that case, pre-global financial crisis, cross-border lendings to banks located in all groups of countries contracted when risk sentiment deteriorated. After the global financial crisis, on average, funding flows went into safe haven country banks and non-bank borrowers when deteriorations in risk conditions occurred. So in sum, what we've seen so far is that in the post-global financial crisis period, things have been characterized by some dramatic changes. A few advanced economies emerged as so-called safe havens. Advanced economies are better understood by separating out the so-called safe haven experiences from other advanced economies. The role of market-based funding has increased, especially for non-bank borrowers. Risk sensitivity of global liquidity flows through banks have declined. And the NBFI funding remains risk sensitive with considerable heterogeneity in types across borrowing locations. So what is behind this pattern of change in risk sensitivity across countries and over time? The next body of work that I'll talk about points to stronger prudential policy and official liquidity facilities in reducing the amplitude of response of global liquidity to risk deterioration. Okay. So key findings, I'm just checking if I'm on the right slide, yes. Key findings are based on considering risk sensitivities after the global financial crisis, both compared to pre-GFC and over time, so through 2021 data. First, and I'm not showing you all of the econometric tests. It would just bog us down too much with the data, but I'll go through the key findings. Better capitalization in banks is the majority contributor to less risk-sensitive cross-border lending. The amplitude of risk transmission across borders is sharply magnified through banks that are less well capitalized. The role of bank capitalization shows as particularly important for emerging market borrowers. Additional stabilizing effects have come from compositional changes within cross-border lending activity. Less well-capitalized banking systems lost market share after the global financial crisis as they focused more on balance sheet repair. In addition, the short-term and more volatile cross-border flows vis-a-vis unrelated banks abroad, this is the interbank lending, has declined, increasing the relative importance of intra-bank lending in cross-border loans overall. In terms of the non-bank financial institutions, data limitations make it more difficult to be as conclusive about the characteristics of the NBFIs involved in market-based financing. Our research uses two NBFI indicators, the asset share of NBFIs with high leverage and the asset share of NBFIs with high liquidity transformation. We do not have institution-specific details on leverage, including for institutions involved in global liquidity flows, and the results are much noisier. However, in market-based funding of borrowers, risk sensitivity appears to be higher when higher leverage types of non-bank financial institutions account for a larger share of the flows. The high leverage NBFI types associated with global liquidity inflows actually are quite different across so-called safe havens, other advanced economies, and emerging markets. For emerging markets, this share represents over 40% of the NBFIs, down from over 50% a decade prior. For other advanced economies, the share is considerably lower, down to about 20% in the past decade. So emerging market borrowers are more exposed through these these high leverage types of institutions. Other research also informs risk sensitivities and informs spillovers of prudential policies across borders. Here, I want to highlight some research conducted through projects organized by the International Banking Research Network. Friederike Nipman, Tim Schmidt-Eisenlohr, and Emily Liu find that only banks that comfortably passed the CCAR, the Federal Reserve's annual comprehensive capital analysis and review stress tests, issued more loans to emerging market borrowers. This is in the context of monetary loosening. Banks also shifted their lending to safer borrowers within EMs in response to monetary easing, leaving the risks of their overall loan books unchanged. Other studies find that prudential policy spillovers across borders depend on bank characteristics in source and recipient countries. As there are heterogeneous results across different countries participating in the IBRN initiatives, we reach general findings using meta-analysis. Spillovers occur internationally through bank lending. Country and sector-specific dynamics are documented by individual countries. Effects on lending differ with bank balance sheet characteristics and business models. Direct effects are actually not large on average in the time period studies, but bank capital requirements played a big role. They were tied to migration of activity across borders and banking systems, with banks with higher initial capital poised to increase lending internationally and sometimes pivoting from domestic loan growth when foreign countries tighten their capital requirements. Changes in some prudential instruments end up spurring market share repositioning across banks and foreign countries. We've also seen that recovery and resolution frameworks for large and systemically important banks have played a role in changing risk sensitivity of banking organizations. My work with Ricardo Correa on US banks and the introduction of living wills shows that these large banks reduced their organizational complexity, but at the same time, this altered forms of risk exposures for these banks. New research also points to central bank swap lines and funding facility access as reducing risk sensitivity. When tail risk events in global liquidity occur, high stress episodes are reflected in higher cost of dollar funding facing borrowers and offshore markets. Some amplification effects arise as borrowers increase demand for liquidity due to their need to meet existing balance sheet funding needs, or due to positioning towards more liquid positions. At least from the perspective of liquidity for such insurance purposes, access to lender of last resort and liquidity facilities should weaken the amplitude and amplification effects of some global liquidity responses to extreme risk events. And in dollar funding, the Federal Reserve swap lines with central banks and the new Foreign and International Monetary Authority repo facility introduced in March 2020 play a role in this respect. by reducing some of the tail risk on dollar funding costs in systemic events. Access to such facilities supported continued credit provision and reduced amplification effects when large shocks hit global markets. Research conducted with my colleague Fabiola Ravazzolo using data for the early months of the pandemic in 2020 explores if the risk sensitivity of different components of global liquidity flows are differentiated across countries and decline with facility access. And this is supported in our analytical work. We also find that the extent of reduction in risk sensitivity and the normalization really depends on the features of some of the bond funds, for example, that were participating. Okay, so my last two themes will focus on risk migration and toolkits. So think back to the stylized history of the last 40 years and to the drivers that I have presented. Pre-global financial crisis, liberalized access by global banks shifted some cross-border lending to local lending through the branches and subsidiaries of foreign banks. More credit access was provided to smaller and riskier local borrowers. Plus, global bank liquidity allocation across their organizations responds to risk. Lending by branches and subsidiaries is actually less risk sensitive than cross-border lending. Intrabank lending is more stable than interbank lending. When shocked, however, global banks follow a pecking order on liquidity reallocation across their foreign affiliates, with core locations more protected than periphery locations, and this is researched and documented in my work with Nicola Cettarelli. After the global financial crisis, those internationally active banks with stronger balance sheets and risk-absorbing capacity expanded market share relative to banks that had to focus on balance sheet repair. And then over time, the frameworks focused on large and systemically important banks, requiring them to set aside more capital in association with riskier borrowers. This then led to some migration of that type of financing activity to market-based financing through NBFIs. This likely was aided by prudential developments, including the enhanced recovery and resolution frameworks, which reduced some of the organizational complexity of the global banks. And we have, again, this risk migration coming about as regulation and innovation fuel expansion of NBFIs and also have been associated with their move across locations internationally. Recent work by Pamela Pogliani, Guts van Peter, and Phil Wooldridge find that NBFIs now account for the largest share of intermediation via cross-border financial centers. They locate more in these financial centers that have less stringent regulation. Funds are channeled across borders via entities with a minimal physical presence, such as booking offices, via special purpose entities, and shell companies. So let's go to the toolkits. Extensive work on toolkits has focused on managing priorities conditional on characteristics of global liquidity. My main lesson is that trilemmas, both the monetary trilemma and the financial trilemma, bind less under stronger foreign prudential policies. This is a positive externality. This insight reinforces the importance of continued focus on risk management and ample risk buffers of global banks, positive global externalities for cross-border lending. Liquidity management within global banks helps fund more information-intensive, relatively stable local lending by their affiliates. However, more peripheral locations are less protected, even less so by cross-border lending. and liquidity facilities by central banks reduce amplification of strains and let them liquefy instead of liquidate their holdings of foreign exchange reserves by central banks. It also emphasizes additional considerations as the IMF integrated policy framework has a focus on recipient country policy. So 2 questions here is whether the framework can explore introducing thresholds on the prudential strength of source countries, or something around the characteristics of specific types of global liquidity providers. So in terms of challenges from risk migration and NBFIs, there is extensive work underway in the global policy community. The Financial Stability Board has a work program on monitoring and enhancing resilience of the NBFI sector while preserving net benefits. The priorities are working on leverage, open-ended mutual funds, data gaps, and regulatory frameworks. They're working on heterogeneous institutions and activities, mapping those, and the efforts span the broader regulatory and policy communities. The IMF analytics and monitoring, and this could be expanded on in the discussion. In 2021, source country policies were actually highlighted as increasing the stability of funds intermediated by open-ended investment funds. And in the recent Global Financial Stability Report, Chapter 3, there was an emphasis on policy levers, including swing pricing and liquidity measures. Frameworks still, I think, need more development around considering challenges from risk migration through NBFIs and to locations with weaker regulations. And also, just for this broader audience here, there are themes that are ripe for research, understanding the NBFI heterogeneity, understanding the interconnections to markets and within markets, consequences for monetary policy transmission, and their potential for amplifying international risk shock transmission. Okay, last point is another forward-thinking point, because we are actually at a conference that has as its second theme forward-thinking. So here, what is the desired endgame? Global liquidity dynamics focus on flows through banks and by purchasers of international debt securities. I've argued that risk migration is a pervasive feature. If more constraints are placed on NBFIs or activities, where does the risk then migrate? Mori flagged in his 2014 comments a role for equity. So the research query for this group is, what is the ideal composition of financing? What's the optimal configuration of debt and equity? If you figure that out, what is needed to move towards the optimal? And then, if you get to a place where equity flows are even more prominent, what other types of issues will arise in terms of vulnerabilities? So I think this is something to think about going forward. So to conclude, first of all, from all of us, congratulations to Mori Obstfeld. Managing the challenges from global liquidity entails appropriately targeting policies using a layered approach using granular data, maintaining a strong focus on prudential policies and effective supervision, focusing on features of liquidity facilities that help dampen the global financial cycle but do not create moral hazard, addressing the continuing challenges that arise from risk migration, and having additional forward-looking thinking on the debt equity frontier endgame. Thank you.
So, Linda, thank you very much for a very comprehensive Mundell-Fleming lecture. This was really a tour de force, and you covered an amazing amount of ground. It's both, I find it both encouraging and very sobering at the same time. It's encouraging because I see the progress that's been done, especially on the global banking system, and it's, you know, we're in a very different position now, I think, than we were maybe, 14 years ago. At the same time, and one way in which we see this is despite the tightening of monetary policy that we've seen from around the world, there's been relatively little happening on the banking side. But it's also sobering because you also documented very, very nicely how a lot of the vulnerabilities may have migrated to the NBFI space, something that we're very concerned about and we're trying to sort of understand better. But we're almost out of time. Let me nevertheless ask if there are any questions from the audience, and I will direct the flow from here. So, Galina, why don't you start? And then we'll have Katie and then Hélène, Adrian, and we'll collect a few and then turn the floor to you for answers.
Well, first of all, thanks, Linda, for the amazing lecture. I've been working in that field, and I still learned a lot. So the question I have, we talk about the banks and NBFIs, and increasingly we see research that it's really a relatively small number of these institutions that's driving most of these markets in terms of the market share as well as market making. And with banks, I feel like, from regulatory point of view, we can kind of figure out in which jurisdictions they are. But for the non-bank financial institutions, do you see, like the way we think about this is still in terms of country of origin and country of destination. But as those financial institutions themselves are becoming more global, do you see that that's becoming potentially an issue both for the regulators as well for the research approaches where we cannot really just say where the money is actually coming from?
Let's collect a few, if that's okay with you. Katie?
It's just a fascinating talk. So you mentioned, Linda, that the risk sensitivities of liquidity flows through banks have declined, mainly due to higher bank capitalization. I was curious if you have preferred measures of bank capitalization, and in particular, I was curious about your thoughts, if you have any on the NYU Volatility Lab S-risk measure from Robert Engel's team. I was also curious if the lack of transparency that you mentioned in some quarters, if that intersects at all with your research on complexity.
Adrian.
Yes, thank you very much for the very nice talk. A question following up on Pierre-Olivier on emerging markets. I am particularly surprised, being Latin American, that we have this enormous tightening and it seems nothing has happened. So should we chant victory? Your data, however, suggests there could be tensions in non-bank financial institutions. Do you see anything that we should be worried about, actual potential problem in the data? Thank you.
Hélène, and then we'll have Maury, and then we'll wrap it up.
So it was a fantastic lecture, super thoughtful, and so I have two quick questions. So one is on your time series of the global risk sensitivity. So there was a break in the financial crisis, then an extended period in which it stayed there, and then there was another break in 2015. So do you relate that indeed to any kind of measures of banking capitalization or any kind of, so how do you explain these breaks essentially? That's the first question. The second question quickly is, so NBFI and so leverage, synthetic leverage, we saw also a massive increase in derivative cross-border trading. Is it something that you can actually take into account in the data? Can you look at the effect of these derivatives trading both on the leverage side but also possibly on the currency side? I mean, how does that interact with NBFI?
Maury?
Linda, thank you. That was really masterful and perfect for the current environment. Since you focused a lot on the history of thought, I'm going to make a history of thought comment relating, and you also focused on the contributions of the fund, so I'm going to go there also. I think it's indicative of the fund's contribution that one of the earliest statements of the macroprudential approach, at least in this millennium, is from Andrew Crockett as Director General of the BIS. And Andrew, aside from being a wonderful man, was Deputy Director in the Research Department in the 1990s. Then he went to the Bank of England. And he was one of the people who spearheaded the the gradual evolution of work in the Research Department toward thinking more about financial stability issues. The International Capital Markets Report, which evolved into the Global Financial Stability Report, started in the Research Department. And sort of paralleling your chronicle of how markets have developed from 1980 was also this growth in interest and in bureaucratic organization here, equipped with more personnel and more expertise to study these issues. Of course, this was also something that proceeded at the BIS, and both of these organizations have made remarkable contributions, and you have been working with people at the BIS very closely, so they continue to do that. But again, thank you for a great lecture.
Linda, why don't you take a few minutes?
Okay, so thank you, everybody. Let me bundle a couple of the questions into responding to the question about breaks and evolution over time. So, what happened after the global financial crisis? So after the global financial crisis, there was an increase in risk sensitivity, and there was a focus on balance sheet repair, and then the dynamics started moving, and then the regulatory community really, I think, made a lot of changes. This is in particular around banks, focused on risk management within banks, focused on, and this goes to Katie's question, on having not just more capital, but better quality capital with the risk-absorbing properties, focused on setting up these living will and resolution types of frameworks, and in general, strengthening risk management. So as that all was going on, there was a transition of some of the activity towards the banks that were more at the frontier of this. And so that brought risk sensitivities down. So also starting around 2014, 2015 or so, when the recovery and resolution frameworks were put in place, the complexity of the global banking institutions declined in some dimensions. And some of that complexity actually gives diversification benefits. So some of that could be reduced, but it made the banks less, by being kind of less big, more easily resolvable in theory. These large banks also became somewhat less exposed to market risk and to systemic risk. So there was a lot that went on the capital side, on the resolution side. Stress testing also was one of the really important, enhanced stress testing, one of the really important developments in the post-global financial crisis period. So that's kind of all on the banking side. On the non-bank side, as Maury mentioned, there's been increasing focus on this really over the last decades, but as these developments happened on the banking side, and there were also technological changes, the migration of activity to market-based funding accelerated. And so I think the attention then on market-based funding has accelerated as well, but there's so little consistent data that has been collected across these institutions, and they're outside of some of the, at least central bank regulatory perimeters, that there's still a lot of learning going on, and there are first and foremost concentrated efforts to learn more about particular types of institutions. What are their constraints? What are the frictions that arise within insurance companies? What are the frictions that arise within pension funds? What are the run risks of open-ended mutual funds? So piece by piece, trying to look at these institutions, figure out what data is available, figure out which types of risks they're subjected to and what types of shocks can have amplification effects. In terms of where they're located, and who are the ultimate investors, we've seen, at least in some of the research community, another way that granular data is being used to try to figure out where the funds coming from. But while that's important, also of critical importance is who's regulating these funds and what are the standards that are applied to them, and how well, essentially, can efforts to make institutions as vast. I mean, there's banks, but then non-banks are hugely heterogeneous. So how do you kind of approach this? And if you this is the old whack-a-mole kind of thing. If you hit down one place, where is it going to pop up? And where, meaning in terms of what types of firms, but also in what types of locations. So I think there's like a really dedicated effort underway, and progress is being made, but it, in a way, has to be made even faster. So I think that in terms of derivatives trading and questions like that, I don't have easy visibility into that. In fact, it was tough even to get the kinds of measures that we've used because of the lack of granularity of that type of data. So thank you, and again, congratulations.
Thank you, Linda. This was really wonderful. So this concludes the first day of the 23rd edition of the Annual Research Conference. We'll meet again tomorrow morning. I think we're starting at 9:15. There we go, someone who knows. And so we'll see you there. Thank you, everyone. This was great. And Linda.